Hi everyone, welcome to my channel. Today we're going to talk about something that might sound a bit abstract, but actually explains how all of economics works: simplification, modeling, and observation from reality. Imagine you're trying to understand the whole economy. Millions of people, thousands of products, prices changing every second. Sounds impossible, right? That's why economists use simplification. Simplification means we don't look at every single detail. Instead, we focus on what really matters. For example, when you want to know why prices are rising, you don't need to study every single store in your city. You just need to look at the overall demand and supply in the market. That's already enough to explain inflation in a simple way. Then comes the second part: modeling. A model is like a map. It's not the real territory, but it helps you find direction. Economists create models, sometimes in the form of graphs or equations, to show how one variable affects another. For example, if the government increases spending, a model can show how that might increase people's income and total production in the economy. One popular model is called the ISLM model. It connects the goods market and the money market to show how interest rates and output move. Together, we're diving deeper into one of the most famous models in macroeconomics, the ISLM model. Don't worry, I'll make it super easy to imagine. So, what does ISLM stand for? IS means investment saving. It represents the goods market, or basically how spending and production in the economy are related to interest rates. LM means liquidity money. It represents the money market, or how people's demand for money interacts with the money supply set by the central bank. Let's start with the IS curve first. Imagine when interest rates go down, businesses find it cheaper to borrow money, so they invest more. For example, when the interest rate is 10%, total spending or output might be around 100 billion rupiah. But when the rate drops to 5%, companies invest more, consumers borrow more, and total spending rises to 120 billion rupiah. If you plot this, you get a downward sloping line. That's the IS curve. It shows lower interest rate, higher output. Now let's look at the LM curve. This one comes from the money market. People need money to buy things, and the central bank controls how much money circulates in the economy. When income or output increases, people demand more money for transactions. But if the money supply stays the same, interest rates tend to rise, because money becomes scarcer. For example, when the economy produces 100 billion rupiah, interest rates might be 5%, but if output rises to 120 billion, interest rates increase to 7%. This makes the LM curve upward sloping because higher income, higher interest rate. Now here's where it all connects. The point where the IS curve and LM curve intersect, that's the equilibrium of the whole economy. It's where the goods market and the money market are both in balance. Let's use an example. Suppose the equilibrium happens when the interest rate is 6% and the national output is 110 billion rupiah. That means, at 6%, businesses are investing just enough, consumers are spending enough, and the demand and supply of money are equal. The economy is stable, not overheating, not in recession. But what if the government increases spending? Say, it launches a new public project worth 10 billion rupiah? That shifts the IS curve to the right because there's more demand for goods and services. As a result, output increases, maybe from 110 to 120 billion. But interest rates also rise, maybe from 6% to 7%. Because the economy gets busier and people want more money, economists can visualize all this movement using the ISLM model. It's like a map showing how fiscal policy and monetary policy affect growth, inflation, and interest rates. So to summarize, IS curve, goods market, negative relation between interest rate and output. LM curve, money market, positive relation between interest rate and output. Their intersection, overall equilibrium of the economy. When the government spends more or cuts taxes, the IS curve moves. When the central bank changes the money supply, the LM curve moves. Together, these two curves explain how policies can push the economy to grow or cool down. And finally, the third step, Observation from reality. After building a model, economists test it using real-world data. If the model says that cutting taxes will boost spending, economists look at what actually happens after taxes are cut. If spending really increases, that means the model works well. But if not, they revise the model, just like scientists adjusting an experiment. So in short, economists simplify the real world. They model it to make predictions. And they observe reality to see if those predictions hold true. This process, simplify, model, observe, is the heart of how macroeconomics helps us understand our complex world in simple ways. Adam Smith. We're going back in time to meet the person who started it all. Adam Smith. The man known as the father of economics, Adam. Smith was born in Scotland in 1723. He was a philosopher and professor who tried to understand how society and the economy could work together to make people better off. He wrote two very important books, The Theory of Moral Sentiments, 1759, and The Wealth of Nations, 1776. These two books are like the heart and brain of economics. One talks about human feelings, and the other about money and prosperity. Let's start with the first one, The Theory of Moral Sentiments. In this book, Smith says something very human. People are not only selfish, they also care about others. He introduced the idea of empathy, what he called sympathy. He believed humans naturally want to understand and feel what others feel. For example, when you see someone drop their wallet and you run to return it, you're acting not for money, but from empathy. This book reminds us that economics is not only about profit, but also about morality and human connection. Then, 17 years later, he published The Wealth of Nations, also known as TWON. This book changed the world. Smith asked a simple question, what makes a nation rich? And his answer was revolutionary. Prosperity comes from freedom. He explained that when people are free to produce, trade, and pursue their own interests, society as a whole becomes richer, thanks to what he called the invisible hand. The invisible hand means that even when people act out of self-interest, they unintentionally help others. For example, a baker bakes bread not because he loves you, but because he wants income. But in doing so, he feeds the community and provides jobs. That's the magic of the invisible hand. Self-interest leading to collective good. Smith's ideas became the foundation of modern economics, capitalism, and free markets. Micro versus macroeconomics. Microeconomics studies individual units, households, businesses, and markets. Example, why does the price of eggs increase? How much should a company produce to maximize profit? Macroeconomics studies the whole economy, national income, inflation, unemployment, and growth. Example, why is a country in recession? How can government policy reduce inflation? In short, micro trees, macro, the whole forest. Circular flow model, this shows how money and goods move between households, businesses, and the government. Imagine this, households provide labor to firms, and in return, they earn income. Firms use that labor to produce goods and services, which households then buy using their income. So money moves in a circle. Income flows one way, goods and services the other. Purpose: to show the interdependence in the economy, how everyone's spending becomes someone else's income. Thanks for listening. If you enjoy learning economics the easy way, don't forget to follow and share this episode. See you in the next one.